Hello and welcome to the Airlie Australian Share Fund quarterly update. I'm Laura Mitchell, Key Account Manager at Magellan Investment Partners, and today I'm joined by Emma Fisher and Joe Wright, Portfolio Managers for the strategy. Welcome team.
Thanks for having us.
Thanks.
Emma, I might kick off with you. The fund has delivered strong performance in terms of both relative and absolute returns for the quarter. Can you talk us through some of the drivers?
Yeah, sure. So it was, a ripper quarter. The fund returned about 11%, which was about 6.5% ahead of the index. And in terms of the drivers, it's sort of, if I look back at the confluence of factors that hurt us over the last 12 months, it's like they all kind of reversed at once. So the big one was the banks. And I've talked about this ad nauseum in terms of how expensive I felt they were, but this additional catalyst that's come over the quarter, that the federal budget was a real record scratch moment for the outlook for investing in residential property in Australia. And for the banks, which are predominantly mortgage banks really, 40% of their flow comes from investor loans. And these tend to be higher margin. So in significantly impairing the outlook for investor loans, we think it really does lead to a deterioration in the outlook for the banks. And obviously sailing into this event, they were trading at all-time high multiples in the case of CBA and Westpac. So that started to reverse, and we think that has a lot further to play out. The second driver has been materials. Now, I wrote a piece, I think with our December quarterly, I wrote a piece about our positioning and our stock picking in the resources sector. So if anyone's having trouble falling asleep one day, you can go back and dig that up. But basically the summary was, we separated, you've got gold miners and then you've got the rest of the materials space. And as we outlined then, we felt that the diversified miners were a pretty good place to be. So we added the Rio to the fund in December because we felt that, we liked the outlook for copper, and we also felt that the iron ore market was going to be more resilient than people were expecting in terms of consensus estimates. And that has really played out over the last 6 months. I think for the year, BHP is up 60% now, and Rio's worked really well as well. On the gold side, one of the big headwinds for us was the fact that we didn't own any gold miners. Now, the gold price peaked at, I think, $5,500 an ounce, US dollars an ounce in January, and it has since fallen to $4,000 an ounce. So in that piece we wrote, we did say that we felt the sector seemed very hot and was probably going to be prone to quite a volatile, potentially sharp drawdown. And that's what we've gotten. If we saw that level of move in the commodity price, as you'd expect, the move in the equities was more severe. I would say that we are now sort of picking over the gold sector. There are a lot of businesses there that have great balance sheets, good management teams. So we're doing some work there now that they have come back down to earth on the valuation side. As it stands today, we don't own any, but that's kind of our hunting ground at the moment. And then the third dynamic that hurt us and then reversed over the quarter was this US dollar earners. As last year, as I was saying last year, News Corp, Aristocrat, BlueScope, a lot of the large positions in the portfolio, operationally, they were doing really well, but their share prices weren't necessarily reflecting that. And we felt that the run in the Aussie dollar and the headwind that meant for their translated earnings was really weighing on the share prices. And again, as that has reversed over the last quarter, we've seen, if you take Aristocrat, for example, not much has changed in the underlying business, but the share price over the last year has gone from $74 down to $47 at one point this year, where we added a lot, and it's since rebounded to over $60. So that kind of highlights the volatility that active managers, hate in the moment, but love in the sense that it throws us off opportunities. And we've been beneficiaries of that, I guess, over the last quarter.
Great, thanks Emma. Over to you, Joe. Staying on the topic of USD earners, James Hardie and BlueScope have been strong contributors this quarter as the US backdrop improves. How are you thinking about those positions and the outlook given the higher share prices and valuations today?
Yeah, no problem. Thanks, Laura. Sort of two different stories there. With Hardie's, the shares are up about 30% this quarter. It's trading on a sort of forward PE of maybe 20, 21 times. Look, we actually think currently as it stands today, conditions are pretty restrictive still in the US from a housing activity perspective. Mortgage rates are up at 6.5%. overall housing activity is pretty sluggish, particularly in terms of new home builds. However, the market has started to look through this, thinking about a recovery on the other side, what that may look like. For Hardie's, North American volumes in their fiber cement business have gone nowhere in 5 years. And so I think, if that can genuinely inflect, and, on our mid-cycle assumptions it will, there's a lot of operating leverage in that business. And so on a mid-cycle earnings perspective, we don't think the shares are that expensive. So it's still a hold for us despite, a good run up in the share price recently. BlueScope's a bit of a different beast. So North American steel spreads have had a really good 6 months. That's a function of, tariffs restricting imports. It's a function of reshoring activity, data center demand. And those spreads flow straight through to earnings in their North Star steel mill in Ohio. Now, spreads move around a lot. It's a pretty volatile earnings driver. For us, the attraction to BlueScope is actually the structural improvement in free cash flow and earnings that we think is going to take place out to 2030. They're rolling off a lot of capital investment that will drive a big step up in free cash flow for the business, and a lot of that investment will start to deliver earnings growth. And we don't think that's priced into the stock even at these levels. BlueScope recently received 2 bids from the consortium of Seven Group and Steel Dynamics, and the shares are trading below that second bid. So for us, it's definitely still a hold from here, and we see plenty of upside.
Thanks, Joe. That's really interesting. Perhaps, Emma, if we could just turn to healthcare now. It's been a very topical sector this year, an absolute train wreck across the park. But we did see a big bounce in some beaten up names like CSL, Cochlear and ResMed in June. How is the fund positioned for healthcare moving into FY27?
Yes, so I mean, I guess I'm smiling because it's supposed to be a defensive sector, but it's been one of the worst performing sectors on the ASX for the last 12 months. And it's sad that you put ResMed in the beaten up category because operationally they haven't put a foot wrong. And so of that pack, that is the one that we own. I think Cochlear looks interesting, and that's, I think Cochlear looks interesting. CSL is one that we've exited. So if I kind of talk through our thinking around those, ResMed, I guess the broader history of our position in ResMed is that we made it our largest position when it had its GLP-1 apocalypse a couple of years ago. Stock got to $21. It's since performed, rallied up to the high 30s, and that was all driven by earnings. Amazingly, the PE multiple has now gone down point to point from the absolute peak of GLP-1 hysteria versus today. So it now trades on 16 times earnings, but it's grown earnings so much that the share price has performed. We did halve our position in the high 30s just to take some money off the table. It has since retraced quite considerably. And again, I don't think they've done anything wrong operationally. In fact, every single quarter they're beating consensus and our estimates by 3 to 5%. It's just that multiple keeps coming down. So when we look at that one, we think it has a really good setup. It's in that bucket of quality compounders that have had this enormous D-rate that we think will turn to a tailwind. And it doesn't even necessarily need to. We think from earnings growth alone, you're going to get high single-digit, low double-digit earnings growth over the next couple of years. But that's obviously going to be, your return will be supercharged if that 16-time P multiple were to re-rate back towards its historic level. So that's one we like. CSL is one that we exited over the year. I talked about it in my January update about the December quarter where we'd used CSL as a funding stock. And over the beginning of the year, we did move to a complete exit. There's been so many downgrades, it's almost impossible to remember which one led to what part of the thesis. But basically, we were very concerned about the channel check feedback around the albumin issue in China. We felt that was going to be a lot more of a medium-term issue than perhaps management was suggesting at the time that they set their guidance, certainly last year. And so that led to a big reduction in our weight and ultimately a complete exit as other headwinds have sort of come up in our channel checks. IG, in the US, it's in oversupply, prices are coming down. V4 has a very troubled outlook. The one thing I would say for the stock, and your comment there around it's had this rally in June, is under our process, the valuation piece, it is very cheap. And I think if you could get some comfort on the earnings, then the multiple probably is a little bit too low. But I think what everyone's struggling with is where do we find a bottom on these earnings? And I'm personally not confident that we have found that bottom yet. And so that's why we no longer own the stock. But it's one that we do stay pretty close to because there is a core of the bearing business there that I think is a really good business. It's just a matter of, finding a bottom, I suppose, on the pricing side, and then, working through some of these headwinds, seeing who they appoint as the new CEO, all of those sort of like really important markers for an investment thesis.
Thank you. Now, Joe, are there any new ideas in the fund that you've added this last quarter?
Yeah, yep. We bought a small position in a company called Ridley. Ridley, it's been a business that's been around for a long time. They manufacture animal feed, and recently purchased a fertilizer distribution business from Incitec Pivot. It's an agricultural business in that the customers it serve are in the agricultural sector, farmers predominantly, and it's also exposed to commodity prices like grain and fertilizer, which creates a lot of noise. It's a very noisy sector. Fertilizer prices have been going crazy on the back of the closure of the Strait of Hormuz. Weather can move expectations around in the short term. More recently, fears around bird flu have come back into the sector and typically tend to emerge, every 2 or 3 years. What we like is actually the structural outlook for the business over the next 3 years. There's an excellent track record of capital allocation, and this fertilizer business that they've acquired more recently from Incitec Pivot, we think there's scope for management to sort of double the earnings of that business over the next 3 years, cycle agnostic. It trades on a forward PE, I think of about 12 times in FY27. It looks really cheap on that basis. And again, we point to the CEO's track record of improving returns, sensibly allocating capital and maintaining a strong balance sheet. And we see no reason why that won't continue. And we think, the fertilizer business he's bought was pretty unloved and poorly run, and there's a lot of opportunity there.
Thanks for that, Joe. And perhaps, Emma, just to wrap up for us today, as we look into FY27, how are you thinking about the ASX 200 and the outlook from here?
Yeah, so I think that the outlook for the index looks quite challenged, and the main driver of that opinion is the fact that 25% of the ASX 200 lies in the big four banks. And, we've not been shy about our outlook there, but I can't believe that CBA, for example, is still $160 and trading on 24 times earnings. It's still the most expensive bank in the world, despite the fact that we're now facing a serious slowdown in the highest margin part of their business, which is investor loans. So we are 10% underweight that portion of the market, and I think that's going to continue. It's begun to be a contributor in the last quarter. I think that's going to continue to be a good source of outperformance for us. Then the other 25% of the index is in the materials sector. And while I'm not calling a top there, you look at BHP and Rio, they've risen over 60% over the last 12 months. They're not going to repeat that. And so we've taken some of the weight out of our position there. We're still overweight, but taken some of the chips off the table, just, acknowledging the fact that this is probably the most cyclical industry on earth. Maybe Korean semiconductors might take that mantle, but certainly the miners are very cyclical businesses. So taking some chips off the table when they've done very well, I think is a reasonable thing to do. But in terms of where we see value, and why I wouldn't say you should necessarily expect poor returns from the fund over the next 12 months, is because these quality compounders have had enormous derates. You haven't really seen it in the headline level and we haven't even come to expensive defensives, but there's been a lot of businesses at the ASX 20 that have done very well over the last 12 months. Some justified like BHP and Rio, some unjustified in our view like Woolworths at 28 times earnings, Wesfarmers at 33 times earnings. Telstra got to 25 times earnings in May, fell 10%, fell like a stone from there while the market continued to rally. And I think Wes next, Woolies is next, the banks are next. So the ASX 20 is not where you want to be. However, there are a lot of businesses that are screaming really good value to us. So businesses like Car Group, we added to the fund on the back of the SaaS apocalypse, Xero, a little bit of Life360 we added, Pinnacle, Orica. We've added more new ideas to the portfolio this year than I think we have ever in terms of our new idea generation. And that is just reflecting the fact that under our process for many, many years, a lot of these businesses didn't pass our valuation filter. We could recognize the quality, but they were trading on very high multiples. So when you've had this enormous de-rate in all quality businesses, high returning businesses on the ASX, that's thrown up a lot of these opportunities, and we've pounced on them. So we're expecting solid earnings growth from these businesses. And then if you lay it in a re-rate, which usually is what happens when, if you look back in history, whenever quality falls away, it then re-rates sharply. And so you'd actually make a case for quite considerable returns from that part of the market. And I think that has already begun.
Thank you. Thank you both for your update today. It's been a very interesting chat. And thank you all for watching. If you would like any further information on the Airlie Australian Share Fund, please visit our website.